I've got 3 hidden gem Canadian oil and gas stocks, high quality companies under a $5 billion market cap that I want to talk to you about today. Best thing is, they're being bought by Canada's very best energy investors right now. Eric Nuttall and David Szybunka run the last 2 energy funds in Canada, and they own these companies, giving that massive seal of approval from the experts on the space and allowing us to dive into what exactly these companies offer that others don't. We're going to start with Tamarack Valley, and I think these guys are a great example of a pure play. These guys run one asset, they run it really well. David's called it one of the best out there. It's the Clearwater. Now, the Clearwater is one of those plays that didn't get a huge amount of attention over the last cycle, but these guys have built a great operation there. They have a fantastic free cash flow yield, and their stock price is already reflecting some serious positive momentum. If you look at where they've gone since Liberation Day, you've seen the stock almost double. Under $4 to $7.50 is huge. And if you think about the commodity itself in that time period, you have not seen anywhere near that kind of bullishness. Price of oil is still under $60, and yet the company has doubled. You might be asking, well, doesn't that mean there's some room for downside? Maybe, but what I also think it shows is the fact that this company was materially underpriced over the last couple of years, right? Investors were not recognizing value, and that the opportunity for torque to the upside when things get better is gigantic. If during a time period where the price of oil literally does not go up, the stock price can almost double, then imagine what'll happen if we do see the price of oil climb over the next 5 or 10 years. Imagine what'll happen at $100 oil, $130. What happens when natural gas is consistently above $4 here in Canada, consistently above $4 in the States? What happens when that lasts for year on year on year on a company that right now has over 20% free cash flow yield? Well, you're going to see one of 2 things. Either one, I think this is most likely, the price goes materially higher. These guys are currently sitting, if I show you right now a couple of key stats, these guys are sitting at a $3.6 billion Canadian market cap with an enterprise value of 4.42. I think you're likely to see their market cap almost at 10 in an environment where we see oil up to or in the range of $100, right? I could see that that's a 3x easily. And to be honest with you, it could be far higher than that depending on acquisition, the amount of hype that gets into the market, how hot the bull market runs, a million different things could play out, but I don't think that's unreasonable. And again, look at the free cash flow yield right now, 23%. So if they don't run, if you do see the commodity rise, they're going to get bought out at a massive premium because it's already evident to most investors, even after the stock has run almost double, that the commodity itself, the asset they sit on, is worth more than the market's paying for the equity. The assets are just hugely valuable. The operations are one of a kind. It's a huge value opportunity. You don't usually see value like this far down the food chain, company this small. And again, look at the price of free cash flow. It's a fantastically run opportunity. And I think one of the biggest things here, they've got a moat. Their focus on the Clearwater, which was overlooked by a lot of larger companies, allows them to acquire assets at a more favorable valuation. They've got scale now in the Clearwater. They've got a huge amount of processing power. It's going to be fantastic for them as you see the commodity price start to raise. But you might be thinking, as I scroll back up to that price chart, they're looking a little rich for a time when a lot of investors have outlined some serious uncertainty about the next maybe 3 to 6 months of price of oil. And of course, there's still those out there who claim that the whole commodity is basically worthless. Well, I think this is a great opportunity personally for me to use a dollar cost average strategy. That's how I'm going to be investing in this company. I'm going to be buying at set intervals. I'm going to aim for every month, and I'm going to be buying at set dollar amounts, meaning that maybe at a $7 stock, I'm only getting 10, 15 shares. But when the stock drops to 6 in a bear case scenario, if the stock drops down to 4, well, now all of a sudden I am doubling the amount of shares I'm buying. Gives me a huge opportunity, allows me to capture a good average price, allows me to mitigate some of the short-term volatility, because this is the kind of stock that I'm sitting on until it's acquired or it doubles, flat out. And the fact that I can see serious major institutional investors that are experts in the space buy in just gives me a huge amount of confidence that these guys are as good as it looks. Before we get any further, I want to thank Moomoo for sponsoring this video. These guys are my very first sponsor here on the channel, so you know they're offering something special for us Canadian investors. Now, if you haven't heard of Moomoo, they're relatively new here in Canada, but they're in over 7 different countries, 27 million plus users. I personally have been using them for the last 6 months, and I found there's a couple key things that set them apart from other Canadian brokers and have made me more and more a fan the more I use them. Now, specifically, one of my favorite things about Moomoo is their low fees. We are talking zero currency conversion fees, which is just excellent. That means that if you're buying something like a share of Nvidia, for example, you're paying $1.99 to make that trade, which is just about the cheapest you're going to find anywhere. And if you're a newcomer, they'll refund you. This means that I can get more diversification into my portfolio and spend less money on fees, saving me a huge amount in the long run. On top of that, they have great research features built right into the app. That means you open up your brokerage, you are hit right away with fiscal policy updates. You're hit with earnings updates. You're hit with forecasts. You're hit with price history. You're hit with all of the key details that you need to make a better investment decision. The best part is if you sign up now with my referral code, you can take advantage of their juicy sign-up bonus. This means if you deposit $100, they're going to give you $50 in credit. So if you want to make better investment decisions and get paid to do it, sign up to Moomoo with a link in the description below. My next stock on the list is very much a curveball, very different opportunity, something that David has outlined as a really high quality company that owns some amazing assets. It's Topaz Energy. Now, you guys might have seen them talked about a little bit on Twitter. There's definitely a couple of folks on there that are really very interested in this company, and shout out, you know who you are. I think this is a really interesting opportunity. It's an infrastructure and royalties company, very different kind of space. And I think this outlines a second really key and interesting fact about these small caps. Generalist investors don't know them. That's not hyperbole. It's not Wall Street is missing out. It's not a headline. It's the facts. Generalists don't buy stocks like this at the start of a bull run. It was put really well in the Baskin Wealth Management podcast not that long ago, where they were talking about why they would own a C&Q and a Tourmaline. And to be fair, it's the same reason why those were the companies that I started with, because they're the largest. They're the most well understood by the market. And therefore, over the long run, you might not see the same kind of explosive upside or the same kind of long-term outperformance, or in Topaz's case, same kind of undervaluation opportunity as you would in these small caps. And so generalists don't buy into a company like Topaz. It's not an E&P. It's sort of that one step removed from the space that some people are focused on when these bull runs start. It doesn't have that same kind of huge commodities exposure that people are expecting to slingshot stocks to the upwards, but it does have an absolute wealth of Montney assets, a huge and valuable relationship with Tourmaline, and it pays out a 5+% dividend year on year. If I show you a couple of the key summaries here, we're looking at a company that, of course, like a lot of these royalty firms, crude and heavy, as well as natural gas and NGLs, you're looking at under $5 billion, again, this time 4.26, with an enterprise value 4.76. In this case, you're looking at a forward price to free cash flow of 13. You're looking at a 5% dividend yield, 5.5% dividend yield. And these guys have just continued to grow their royalty. Short term, don't know where the story is going, but I don't see a huge amount of volatility. But if you think about the asset base that the Montney is right now, if you think about the value long term of the Montney's assets, much younger than the Permian. We have seen American firms coming and scooping up assets where they can find them. This company needs to be more highly valued by the market, or it will be by a buyer. Flat out. This company is a huge undervaluation for the assets it sits on, because the value of those Montney assets are going to continue to grow year on year on year. And the acreage, or the actual assets they own, is fantastically well positioned with awesome infrastructure, allowing for a huge amount of profit from the companies drilling on it. I just don't see a world where these guys don't continue to grow their royalties revenue, continue to grow their infrastructure revenue, or get bought out. Again, in this space, small caps that don't get the attention from generalist investors, one of two things happens. They get bought at a premium, where you get that short-term payout, or they massively increase in the long run, and you get those huge long-term outperformance stories that you've seen with a couple key names. Speaking of long-term outperformance, we got to talk about our third stock on the list, and it's an Eric Nuttall classic, Athabasca Oil. Now, I think one of the most interesting things about Athabasca is when asked where the next Athabasca would come from. Because if you look at the stock, right? If you had bought this thing in January of 2021 and just held it, you would be looking at an insane total return. If you look over that time period, right, just the run up, 18 cents to $7+, right? That would be life-changing money. And when asked about this, Eric Nuttall said, Athabasca is the next Athabasca. He says that maybe not the exact same returns, but there are still huge returns in this company's future. And to be honest, I agree. They are obviously focused on the Athabasca region. These guys are, again, there's a $3.6 billion market cap. This is a tiny company in the space, and yet free cash flow margin of over 15%. Talking about a price to free cash flow of 17. We're talking about a huge return on equity, 31%, just a huge amount. We're talking about the fact that these guys are continuing on their thermal oil production. They're continuing to reduce debt. Oh, did I mention net debt is functionally nothing? And they have, again, a counter-positioned portfolio focusing on thermal oil. They've kind of been avoided by larger players. They haven't been scooped up the same way that lots of other competitors have. And the opportunity here is the fact that these guys, even as the stock has run up, they are going to play out the Nuttall playbook. You might be asking, what does that mean, right? What's the Nuttall playbook? Well, instead of growing by, acquiring and investing a huge amount, even though I do love a counter-cycle acquisition, instead of that, right now, their focus is on shareholder return. And there's two key things you can do to boost shareholder return: the dividend and the buyback. And right now, there is nothing that screams opportunity to me like share buybacks as the price starts to move and the equities don't. As we wait and we watch the price of natural gas start to rise, and yet the natural gas stocks in Canada haven't exactly boomed since the fall. As we wait and watch Canadian oil equities flat, they're not down, right? The market started to recognize the large caps, but more or less flat. And then the price of oil bottom. And then you see the market start to notice as it rises. As you see that play out, these guys are going to be taking their free cash flow with their zero debts, and they're going to pay them straight back to the shareholders. They're going to grow your ownership stake in the company. They're going to grow the slice of the pie that you have access to. And of course, they're going to make all those per share metrics look better and better and better and better. These guys could see a massive amount of free cash flow return to shareholders over the not so distant future, right? We're talking about, anywhere from, I've heard numbers from 30 to 60+% of the stock bought back, 30 to 60+% of free cash flow over the next 5 years straight in your pocket. And so it's the kind of stock where, what's the downside? Again, I'm definitely employing a dollar cost average in a stock like this, right? We're talking small cap volatility. The last year has been pretty good, right? From $6-ish after Liberation Day to, or even lower than that, honestly. I think it was down to the fours, but up to $8-ish, $7.5-ish, right? That same kind of, whoa, huge opportunity. Lots of people made a lot of money, but the next couple of months, who knows? So dollar cost average makes a lot of sense. But throughout that time, I get access to a really high quality thermal oil business with a high quality asset that is under a $5 billion market cap. The asset has basically been ignored by the market. Generalist investors haven't noticed it whatsoever. And so the time period that I can acquire shares is going to last longer. And that's kind of my third and final point that I want to make about these small caps. They're overlooked, and so they stay low for longer. Yes, a lot of them have run over the last year. There have been key investors, again, like guys like Eric, guys like David, who noticed the space and have invested, but they're just such a tiny slice of the pie. The Canoe Energy Fund, we're talking like $1 billion. We're talking the opportunity here in a stock like this, when you see $100 billion, $500 billion fund, when you see pension funds looking for opportunities, is gigantic. And again, your downside is basically capped, because if the market doesn't recognize the value, it's going to get bought out. And so here are 3 stocks, each of them offering something unique, operating a hugely valuable and yet cheaply priced business in the Canadian space They offer that same huge undervaluation opportunity that we've been talking about in Canada. But as the large caps start to get recognized for their quality, these guys are getting left behind. And I'm going to be scooping up shares. I'd love to hear your thoughts in the comments down below. What do you think about these 3 stocks? Are there others that you would pick instead? Please do let me know. Also, if you like this kind of content, please do like the video. It makes a huge difference for us. If you like talking about these Canadian topics, specifically, of course, we've talked a lot about energy over the last couple of months. Please do subscribe, and I hope I catch you in the next one.